Good afternoon, everybody. Fred Hensler here. Hope everybody's enjoying the holidays. I wanted to take a moment and bring on one of the associate directors of research and a portfolio manager, Matt Watson, to discuss what's been going on in the market. As a professional that's been doing this for many, many years, we have seen times when clients become very concerned about what's going on in the market, and we wanted to address those situations to make sure that you had a level of comfort in the market and with how your portfolios are being handled. So, with that in mind, I've asked Matt Watson to go ahead and join us. Matt, I'll tell you what, it's been a wild sleigh ride. It's been like sitting next door to Santa Claus on the sleigh with the reindeer jutting all over the place. What's going on as far as the investment markets are concerned right now?
Well, Fred, first let me say we want to wish you and all of your clients a happy holidays, and it's a pleasure to be with you today. And we're happy to, of course, talk with you and kind of go over what we're seeing. As you mentioned at James, we've been doing this for many decades, and so we've got a lot of experience with these types of markets. And again, happy to share our thoughts with you. So, as you mentioned recently, it's been a very volatile ride, and we're actually experiencing one of the worst December months actually in the history of the stock market, believe it or not, going clear back to 1931, which was actually the Great Depression. I think we're pretty close to that record of a down December month. We're not quite there yet, but of course the month is not over yet either. So it's very natural for clients to be very concerned today. Again, just by the data that backs that up with the performance of the December month. Now, having said that, this is something that we have been anticipating at James, and we've been positioned conservatively because of that. Back in the summer months, even at the earlier part of this year, when we had a nice downturn in towards the end of January, into February, we were positioned there. We did some buying coming out of that, and then we became conservative again towards the latter part of this year, especially into that third quarter time period. I think the all-time high in the market was close to September 28th, and it's been a pretty wild ride since then. So, in the short, sentiment was very bullish, towards the end of September into that October time period, and valuations were very, very high. The good news is both of those have moderated. Sentiment is actually, I think, pretty bearish today, and we'll talk a little bit more about that. But from a long-term perspective, valuations are still pretty elevated. But I think in the short run here, to make a long story short, we could see a nice rally.
Well, you mentioned a bear market, and it seems like every time you turn on the television and listen to one of the talking heads there, now they're telling us that we potentially could be entering into a bear market. Can you go ahead and explain what we could expect if, in fact, that's the case, and what James Investment Research thoughts are? Are we actually entering into a bear market, and should we have some concerns about that?
Sure. Well, I would say that most of the major indices are actually already in bear markets. If you look at the transportation index, I think that's down over 20%. The Russell 2000 down over 20%. We really started to see a lot of divergences in the earlier part of this year when international stocks were down a lot more than U.S. stocks, and eventually that seemed to catch up to the U.S. equities. And so even divergences between small and large in the United States was also sort of one of those canaries in the coal mine that we pointed out in our research leading up to this. So I think if I think we're pretty close to a bear market, if not already there in the Dow and the S&P. So James has been in the past one of the best money managers in the country, frankly, to sort of toot our own horn a little bit there. Back in 2008, we held up very well for clients compared to the stock market as well. We held up well in the 2000 to 2002 time period. So capital preservation is sort of our mantra, here at James. And 10 years into the bull market, people started to forget that. But
Sure enough.
yeah, and maybe people started to ignore that and extrapolate those great times into the future. But here we are again. So we think that again, capital preservation is key. Defense is important because it doesn't take a whole lot of offense to overcome small losses. But if you have large losses, it can take a while to recoup those. So, and active management, that's another thing we're known for here at James. And so we've actually been adding a small amount to portfolios here at these oversold levels. Again, counterpunching when we can and trying to, earn the best risk-adjusted returns we can for clients.
Absolutely, absolutely. And you had mentioned in regard to the bear market and the bull markets obviously being times when investments increased in value over a substantial period of time. You and I have both been around for a long time. I remember in 2000 to 2002, and again in 2008, people really got whipsawed. And what I saw with so many of our contemporaries in this industry, there was often, I called it the excuse of, well, just hang on. Well, that's because people or advisors didn't have anything else that they could offer but to just hang on and hope it recovered. And many of us forget that it took almost 9 years to recover from the last time that this happened for those investors who may not have utilized a conservative based investment like James Investment Research. Now, with that said, I know I'm getting some conversation with individuals who are not particularly clients of ours that are saying, gosh, I see 2008 all over again, and I'm just going to bail and get out of the market. Is that a good strategy at this particular point in time?
We don't think so. No, we think that that's a very risky strategy actually if you do that because again you tend to see very very strong rallies in bear markets. Believe it or not, the bear market rallies tend to be even more vigorous than bull market rallies. Because equities can get pushed to these deeply oversold levels like we're seeing today, in fact, and so we wouldn't be surprised to see a 5 or 10% rally from here at these levels, even over a very very short time frame. So that's why we never recommend clients. We're more of a balanced manager. We never would recommend clients to get completely out, even for very, very conservative clients, because the market's not rational, and we don't treat it as such. And we've learned over many decades of managing money that it's best to move slowly and to try to buy on weakness and sell on strength, and to do that over a period of months in the long term, because bear markets can last for months. And so, our director of research, David James, likes to say that, the stock market doesn't go straight up or straight down. Typically there's more of a sawtooth pattern in both directions. So, we've developed over 100 indicators that we use on a weekly basis to, try to put our clients in the best position to benefit from those rallies. And that's kind of what we're seeing today.
Sure. And now I know that there are some fears out there. What if this time it's another repeat of the Great Depression? And one of the things that James Investment Research has used that I've always appreciated, you guys refer to them as tripwires, and basically that's a situation where the economy and the markets are set up where we could potentially experience a massive, massive decline. Not that 20% from the top isn't massive, and by the way, I would like to remind everybody that James is not down anywhere near 20% for this year, while some investors might be finding that they're down 20% from the top. But are you seeing any of those tripwires in place right now that should cause clients to really have concern that there could be a major, major decline? And if not, and they came about, how would you go ahead and handle that?
Sure. Yeah. Well, as I mentioned before, we think that in the long run, valuations are still fairly elevated. So that's why we still have a fairly conservative overall investment position. But, we have been adding recently, I'd say in the past week or so, to try to take advantage again of those deeply oversold levels. So if we see a rally from here, maybe 5 or 10%, we may use that to lighten up again. If we see, some of those, if we say, one of the things we look at very closely is the yield curve. So the yield curve is very flat today, meaning that the difference between short-term interest rates and long-term interest rates is not very different today. They're pretty close together, and so that signals kind of slower economic growth to us. So we would watch that signal very carefully. We'd also watch sentiment very carefully. Sentiment's very negative today, so we use that as a contrarian bullish signal. And then, lastly, we look at some of the technicals of the market. The 200-day moving average is a very common one. We recently had where the 50-day moving average crossed over the 200-day moving average, so they actually call that the death cross in fundamental, or excuse me, in technical terms. But yeah, but conversely, there's also the one called the golden cross. So if we, you can see those as well. So we are, again, fairly conservative today. We're kind of playing maybe a short-term rally here, and then if we did see that, again, based on how things progress, we would potentially use that to get more conservative. Or if we see that things are still pretty negative and our indicators are still favorable, we might continue to hold that slightly more aggressive position. So one of the things that's actually more positive today is actually company earnings reports. We read a lot of company earnings reports from managements, and kind of get the boots on the ground kind of a view on things, and a lot of them are pretty confident about 2019. So again, those are coming from the operators on the ground floor there. Even though maybe some of the overall macroeconomic data is not that favorable, the micro still looks okay to us. So that's why we do both types of research and try to pair those together to put it into an overall picture for our clients.
Sure. I know that you'd mentioned somewhat potential for overvalue. For the general person out there that doesn't really understand the markets, there's two theories. Number one says buy and hold, and the other one says buy when markets offer opportunities. Is this a time to buy, or could we see the potential for even further deterioration in the values of the stock markets? And let me mention that you and I, in James Investment Research, talk about two different sides of the market. There's the growth side of the market, and then there's the value side of the market. And I know that James tends to lean more towards purchasing undervalued securities. So where do you go with your money? If somebody had $100,000 or $500,000, or they were rolling over their 401k today, what would one recommend that they do with those funds?
Sure, that's a great question, Fred, and I'm glad you brought that up, because we do see, when I talk about the market overall and valuations being expensive, you are right. We are largely talking more about that growth side of the stock market. The stocks that we hold individually in client portfolios, we're finding great values there, to be honest. We're finding a lot of companies, especially in the consumer and industrial sectors, basic materials as well, selling for less than 10 times earnings. So to give you an example, if you're buying a company at 10 times earnings, you're basically getting about a 10% per year return, assuming that everything stays the same. But in some cases, we're seeing companies below 5 PEs, even below 3 PEs. So your returns really shoot up the lower valuations that you can buy. So we are finding great values, and those are largely the stocks that we're buying and holding in client portfolios. However, when we talk about the overall market, like you mentioned, the growth, especially those FANGs, those have been down quite a bit recently, and the growth stories are being punished recently. So we are finding great values for clients. So if clients wanted to add money today, we think today is a great time to add money, especially to an active balance manager like ourselves, that we can, you can confidently add today, because you'll know that we're going to manage that risk for you no matter what happens in the future. It's not like, you're going to put it in and we're just going to buy and hold it forever. So if we see good opportunities, like you mentioned, buying on weakness, we'll do so. And then if we see opportunities of, selling on some strength, we'll also do that as well.
Matt, thanks so much. I really appreciate it. I think one of the critical things that you talked about is let us manage it. There's been a lot of money going into a lot of the index funds right now. People are kind of throwing caution to the wind and forgetting about what happened in 2000 to 2002 and again 2008. And in both of those periods of time, James Investment Research came through pretty much unscathed and allowed them to kind of march forward, which has been some pretty spectacular opportunities as we looked at it. So
exactly, yeah. And I would just add too, Fred. Yeah, before we go, that we're highly confident in our abilities to manage money personally, and all of our employees here, we invest in our own styles and funds. So we've recently been adding to those. So we believe in what we do, and we didn't really talk a lot about the fixed income side, but that's again one of our bread and butter areas. We've been holding a lot of U.S. Treasury bonds, which have been doing very very well over the past few months, and so that's another one of the areas that we actually like today for that high quality income, and we've been avoiding some of that lower quality corporate bonds, so that's been a good thing for us.
Excellent, excellent. Again, Matt Watson, thanks so much. I appreciate it. For those of you listening to this conversation today, if you do have any questions in regard to what's going on in your personal portfolio, please feel free to give us a call, 810-714-9456, 810-714-9456. And quite frankly, if we want to talk personally about your portfolio and even bring James Investment Research on the line, I'm sure we can make arrangements to have that happen. So again, any questions, we look forward to talking to you. If not, we wish everybody a blessed and happy and successful 2019. Matt, thanks so much.
Thank you.